Okay, so I'm going to be building a bit on what Tom was talking about. I'm not sharing our tax and insurance default paper, but I will sneak that statistic in at the end. So you will get to hear from that. This is broader research with co-authors, two of whom are here, with Don Haurin, Max Schmeiser, and Sam Dodini from the Federal Reserve Board. And our usual disclaimer, this is part of a larger project that is funded by HUD and the MacArthur Foundation, but the ideas that we share here are our own, not those of either of these places. And also, of course, the Federal Reserve Board is not responsible for anything I say. All right. So the motivation is really stemming from what we've been talking about today. And actually, the previous panel talked about how in the SCF data, you can see that the majority of assets for a large portion of the aging population is held in the home. A home equity comprises a large share of assets. So how can folks access those assets? One of the things that we're talking about on this panel is the use of reverse mortgages, and that's actually our larger study looking at reverse mortgages. But this particular paper, we wanted to look at how the use of reverse mortgages compares against other types of equity extraction that seniors might consider. So while folks have looked at equity extraction among seniors and whole, or they've looked at particular channels separately, there hasn't been prior research that has jointly considered different types of equity extraction channel in addition to the reverse mortgage. So looking at these all holistically and the factors that might lead households to withdraw through one channel or another. Folks have different options when they want to extract equity from their home. They can, of course, sell the home. They could downsize. Or they could use a loan. And there's three different types of common loans that we're looking at here. One is cash out refinancing, another being a second lien on the home, or a HELOC, the home equity line of credit. The reverse mortgage is a fourth option that you could use if you're over the age of 62, as Tom mentioned. Could be structured similarly to a HELOC, could be structured similar to a cash out refi. Actually, 70% of households took out the money as a lump sum at closing, so much more like the cash out refi. And there's different reasons for that, which we can discuss later, but that has become a more popular option. Changes recently will make that less popular. All right, so I've mentioned some of the research questions. Really, we want to understand what are the factors that are associated with extraction through these different channels. There's two sets of factors that we care about. Building a bit on what Tom was talking about with house price dynamics. Obviously, we think house price dynamics affect your decision to extract equity and may differentially affect different channels. We have some theoretical reasons in the paper for why we think different channels may be affected differently. I'll hint at those, but given the time constraints, I'm not going to go into detail on those different expectations. We also want to wrestle with this question about minority neighborhoods that Tom mentioned. So there have been correlations observed between different extraction channels, including HECMs, in higher minority neighborhoods, but also other types of loans, which I'll show you. We want to try to understand if we can decompose the proportion of that variation that might be due to differences in endowments of individuals living in those neighborhoods, differences in behavioral responses of individuals living in those neighborhoods, or maybe other things that we can't measure, like financial literacy, which was talked about earlier. All right, and like I mentioned before, we're building on other studies, but there hasn't been a study to our knowledge that's jointly estimated these four different things among the senior population. So this is just some pictures to give you a sense. We're looking at the origination rate of a new extraction product. So some folks have modeled the percent of seniors who extract equity in a given year. That's different from the percent that are originating a new extraction loan in a given year. So we're looking at the percent that are originating a new extraction loan in a given year. Think primarily about HELOC. So you could originate a HELOC in year 1, and then you may not extract anything on that HELOC until year 5, year 6, year 7. So we're measuring the percentage of folks who are originating a new extraction loan in a given year. Across our sample, about 4% of seniors, and this is based on a random sample of the US population using consumer credit panel data, which I'll talk about in a moment. About 4% of seniors over the age of 62 originate a new extraction loan in a given year. Very small, originating a new extraction loan. If we compare that to percent of seniors extracting equity, other research has suggested it's about 8% of seniors extract equity in a given year, which compares to about 12% of the total population that's extracting equity in a given year. And you can see this has declined over time. We're looking at the period 2004 to 2012, much higher 2003, 2004 peak period, and then equity extraction among elderly origination declined. We also see some of the channel differences. And so HELOCs were the most preferred form of equity extraction among the senior population. So you can see that it was about 4% in 2004, declined to almost 1% in 2012. Of this total senior population that originated a HELOC loan. And so you can see that's going down. The other channels that I'm looking at, that we're looking at here, are actually below 1% during the whole time period. So it's a very small fraction that are originating equity extraction through any of those other channels, but there's different peaks and valleys. So you actually see these things peaking at different points in time, which makes us think that there could be differential responses to house price conditions and credit constraints depending on the channel that you're using. You also see what Tom mentioned here about the HECM share is this dotted line that kind of peaks in 2009. That's the percent of originations through a HECM relative to all other types of originations, and they peaked in 2009 and then subsequently decreased. So we think this could be related again, some of the house price dynamics, credit conditions changing around that time period. I'm going to show some pictures, also trying to show, similar to what Tom mentioned, there's some geographic variation here, obviously correlated with house price dynamics in these sand states and other geographies that we think are important. For the sake of time, I'm just going to flip through this. You'll see HELOCs is here, and I'm going to go through cash out refi and HECM. These are the quartiles of origination extraction rates. And so the darker areas are states that had higher origination rates than the lighter states. HELOCs, you can see concentrated where you'd think they might be concentrated, areas with higher house price appreciation potentially. Cash out refinancing, slightly different than HELOCs. You can see a different picture emerging, and then we move to HECMs, and you see a slightly different picture emerging there as well. So these things aren't all moving in the same way. We're going to zero in at the zip code level. So our analysis is actually going to be conducted at the zip code level. We look at origination rates of these different types of loans aggregated to the zip code level. And we're looking within an MSA in this particular picture. We're looking at Chicago MSA. And we want to see if there's variation even within an MSA of where these things are being originated and the penetration into a market. So the darker, obviously, zip codes are the areas where you have higher penetration of an extraction loan. We have a green dot here to signal that 90% of the population in those zip codes are white. And we have a blue dot to signal that more than 50% of the population in those zip codes is black. Getting to Tom's point of this correlation that we've seen before. And as you can see, the HELOC origination rates during this period were concentrated in predominantly white neighborhoods. If we move to cash out refi, others have found this with general homeowners in the population. We observe the same thing with the population of seniors over the age of 62, that cash out refinances are also highly concentrated in these higher minority areas. Again, it's just a correlation. We don't know why yet. And then with the HECM, you also see a similar pattern to what you see with cash out refi, although it's a little bit different, where they also tend to be concentrated in these higher minority areas. So these are questions that we want to try to address. We're using data from the New York Federal Reserve Board's Consumer Credit Panel, Equifax data. We supplement this with data on HECMs. We have the public HECM data. We also have some actuarial HECM data. We use data on CoreLogic house prices. So we use the house price index at the zip code level and also median house prices, IRS tax data on incomes of seniors over the age of 62. And then we supplement it with some census data. We limit it to zip codes that are within CBSAs. We limit it to those that have at least 30 observations. And so we get down to about 5,495 zip codes. And then we use this as a panel. Every year, zip code becomes an observation in our data. And so we're going to model these four things simultaneously, with the fifth omitted category being that you don't extract equity, or you don't, maybe you aren't even a homeowner. So the extracted, it's accounting for all potential conditions of individuals using equity or not using equity. The four different channels that we're looking at are the HELOC origination rate, the cash out refinancing origination rate, the second lien origination rate, and the HECM origination rate. We allow the errors between these equations to be correlated using a seemingly unrelated regression, because we think that there are factors that might be associated with a higher HELOC origination rate, for example, that are also correlated with a higher HECM origination rate. So we want to model these things together. The explanatory variables that we think are important, again, the two sets that we have most of our theoretical expectations about are related to house price dynamics, given some of the reasons that Tom mentioned, and as well as credit conditions. So we know credit conditions change geographically, that there may be a greater supply of credit in certain neighborhoods. We also think that individuals in certain neighborhoods are differently credit constrained, and that might affect their ability to borrow. And we know, for example, that HELOCs tend to be portfolioed. They tend to have higher underwriting requirements. They tend to have higher borrowing constraints. They require higher or lower LTVs in order to originate them, so you have to have more equity, whereas a cash-out refinance, for example, tends to be traded on the secondary market, tends to have, during the time period that we observed at least, tend to have more relaxed underwriting requirements, so maybe targeting different types of consumers. So there's various reasons why we might observe differences here. Also, for the reason that Tom mentioned, HECMs have this kind of built-in insurance feature that protects against house price risk. So if your house prices go down and you can actually still continue to borrow at the rate that you locked in the house price day one, it can be a hedge against house price risk, whereas a HELOC could be reset, the HECM cannot. So that might encourage differential behavior in response to house prices as well. All right, and then we also want to look at, Mian and Sufi had an interesting paper where they show that the folks that responded most to house prices, increases in house prices, were those that were the most credit constrained. So the increase in house prices relaxed the borrowing constraint among credit constrained households. So they actually show that if you just limit it to credit constrained households, that's where you see folks extracting equity. We want to see if that's true for people over the age of 62, that it's occurring most among credit constrained borrowers. And then also, is that true across all channels? And so we estimate an interaction there, and then we also run some subsample regressions by zip code. All right, so some overall findings, we do find heterogeneity by channel and the responsiveness to house prices. So I'm showing some marginal effects here because, again, the actual rates, origination rates of these extraction loans, you can see down here, is quite small. So these are the marginal effects, the percent change in an extraction rate for a 1 unit change in our independent variables. You can see that HELOCs were much more responsive to positive house price growth in a zip code, more likely to originate HELOCs. Not so much HECMs. On the other hand, HECMs more responsive to house price decreases. This corresponds with an idea that folks might be seeing house prices declining in volatile house price areas and originate the HECM to lock in their house prices, whether it's something that they knew because they're all-knowing or strategic consumers, or it's simply that the brokers in the area knew this, or the lenders in this area knew this. It was a smart strategy. They marketed the loans in those areas to lock in house prices. We also see that credit seems to be important for the forward mortgage loans, not as much for HECM. It's still significant, but not as much of a factor. I'm going to skip ahead here. This is moving on to Mian and Sufi's hypothesis. So I think this is interesting, and we actually find some interesting heterogeneity in this. So the idea that individuals that are more credit constrained will respond to the house price increases to lock in equity extractions. What we would expect to see, we hold mean credit score at 784, and then we lower the credit score to 20 points below the mean, and then we increase the credit score to 20 points above the mean, 1 standard deviation below and above. And if you think that credit-constrained borrowers are going to respond more to these house price increases, we would expect to see that the percentage of folks, or the increase, the marginal effect of a 1 percentage point increase in the house price rate to actually be higher among this group of individuals, the credit-constrained individuals. And in fact, you see that it's lower overall, so 0.49 to 0.15. And you see that those that have higher credit scores actually are more responsive to house price increases. This is the opposite of the overall population finding that me and Sufi found. However, when we look at it by channel, we see something interesting. So if you look at the cash out refi channel, you actually see that it behaves the way Mian and Sufi suggested. So if you look here, you see a 1% increase in the HPI rate, 0.22, and then among the credit-constrained population, it's higher, and it's lower among the less credit-constrained population. For HELOCs, though, it behaves in the opposite direction. So for HELOCs, it's the more sophisticated consumer who was locking in their house price increases through a HELOC, less sophisticated consumer locking in house prices, or not locking in, cashing out on the house price increases, sorry, through a HECM, or a cash out refi. All right, so now I want to start looking at the differences in those minority and non-minority neighborhoods. So we mentioned, you saw through the pictures that there were differences in the origination rates of these channels in minority and non-minority areas. We want to see how much of that we could explain by some of the endowment and behavioral effects related to credit constraints, house price dynamics, and then the other variables in our models. The nutshell is that, yes, we can explain a lot of these things, and let me show you what some of those actually are. So if you look at house price growth, for example, and we look at the impact of house price growth on the origination rate of HELOCs in high minority and low minority areas, you see that in the low minority areas, they're actually not responsive to increases in house price growth to lock in the HELOC, for example, that's not significant like it is in the low minority areas. Whereas with credit score, for example, cash out refinancing, less likely to use cash out refinancing in low minority areas. It's probably more expensive than a HELOC, for example. If I have other options available, I don't go to the cash out refi. Whereas in high minority areas, credit doesn't seem to be a significant predictor of the cash out refi option. Interesting as well, when we see this negative response to house price decreases, that folks that have negative house price growth in their area, more likely to lock in a HECM in low minority areas. So suggests that in these low minority areas, you see this more sophisticated response, where folks are locking in that negative house price that the house prices are going down, they lock in their equity. We don't see that same response in the high minority areas. So it could be a sophistication story, potentially. And then we also see that as credit score rises in low minority areas, they're less likely to lock in through a HECM, which could suggest that they are favoring perhaps more affordable options, not responsive in the high minority neighborhoods. So overall, some kind of broad takeaways from all of this. Definitely do see differential responses to house price increases and credit constraints in high and low minority areas. We also see differences in responsiveness by channel. And we think that this channel is actually a very important thing to add to the discussion when we talk about how seniors might be extracting equity. And again, the responsiveness to credit constraints, the responsiveness to house price increases and credit constraints also seems to vary depending on the type of product we're talking about, the type of channel that we're looking at. All right, so now I want to move to some kind of interesting discussion and implications. So this is going to bring in some of the work we've done on tax and insurance default with this particular paper here. So as of April 2015, the HECM program recently established underwriting standards for the first time, credit risk-based underwriting standards for the product. So they actually now, previously they didn't underwrite based on your ability to pay. Because tax and insurance defaults were running around 12% in 2014, about 12% of reverse mortgage borrowers had defaulted on their tax or insurance payment, combined with other factors such as projected losses to the MMI fund. They enacted credit underwriting requirements. And these credit underwriting requirements, we have another paper where we estimate what the impact of these requirements might be on HECM volume, as well as on the default rates. And we see that if you just implement the credit standard, there's other changes that have been put into effect. The reduction in HECM volume would have been about 6%, but the default rate would actually be cut by almost in half, so about 40%. So a significant reduction in default rate, small reduction in volume. But then we ask, so these people that are then shut out of HECMs, where would they go? Would they extract equity through other channels? Would they go to another not extract equity? What would happen to these folks? So we did a back of the envelope calculation where we look at the characteristics, the average characteristics of our 6% who didn't get HECMs from this population. We look at the mean characteristics of these individuals, apply them to the average characteristics of people who extract in HELOCs, cash out refi, or second liens, or no extraction. And we actually find that they're more likely to extract through cash out refi or maybe second liens. This is important if you think about the fact that during this time period, 2004 to 2012, folks that originated mortgages through cash-out refinances oftentimes were ending up in a negative equity position as of today. So they often were cashing out 100% of their LTV. Homes then declined in value. They were unable to make their payments. They could have then been at higher risk for foreclosure. With the HECM, you have a built-in protection against this house price risk. So if we think that this insurance feature of the HECM is actually important to protect seniors, turning to the cash-out refi option might have actually increased foreclosure rates. And we actually have just recently run some statistics. There's the foreclosure rates among cash-out refi of folks in our population, 62 and over, are 2 to 3 times as high for cash-out refinances as they are for HELOCs extractions. So could be a potential issue. All right, thank you.